Let's stick with hip pocket issues though, and that's interest rates, of course, very likely to go up, almost universally thought to be the case by economists. Martin North joins me now, the principal with Digital Finance Analytics, a local financial analyst. Martin, good morning. I'm assuming you're with the rest of your economists' comrades, and you think that interest rates will rise today. It's just a matter of how much.
Well, yes, the Reserve Bank has got a real headache. Inflation is raging, and as we heard a little earlier, and for non-discretionary spending, it's well above 6% annualized. So, these are big numbers. They have to do something. The only lever they've really got is the interest rate lever, which is a very, very blunt instrument. But I am of the view that they will be lifting rates at least 25 basis points. It could well be 40 basis points to go the rate up to 0.75%. Some people are even saying they could do it even more than that. A bit of a sort of a signal that they really are intent on moving rates higher. But of course, the consequences are significant.
You say it's a blunt instrument, and if we just do a little bit of economics 101 here, so basically you make people pay more on their mortgage, so they spend less elsewhere. So the idea is the price of things come down a little. But some of these things, the influences sit outside of that equation, don't they? So will it have the desired effect?
Well, the real question is, why is inflation high? It's partly high because of the fact that the Reserve Bank created a lot of money and took interest rates ultra low. That stokes the credit sector. But of course, a lot of it is supply chain related, and we also have the international issues as well. The fact is, inflation was rising late last year into this year before the Ukraine conflict, and of course a lot of people are blaming the Ukraine conflict, the whole problem. No, it's just part of it, right? So it's multi-headed.
It's just turbocharged a problem that already exists, maybe.
Yeah, it was already there, and I think we had a chat last year, and I was saying, look, I'm really concerned about this because it's definitely heading the wrong way. The fact is that with supply chain related issues, you can only indirectly address it with interest rates. So what you're doing is you're trying to force demand down. In other words, people will be less able to buy things, and that will then actually get supply and demand more in line, and therefore it might cure some of the inflation. But a lot of the stuff that people need to buy, you need to buy. You need to buy fuel, you need to buy food, and you need to use power, and you need to have gas. And unfortunately, a lot of those things are embedded in the way that we live, and therefore I'm not sure that lifting interest rates will necessarily tame inflation. And that, of course, is the worst-case scenario, because around the world we're seeing this very high level of inflation. In the UK now, they're talking about inflation maybe being above 10%.
Whoa.
And in New Zealand, they lifted interest rates to 2% last time they lifted rates by 0.5%. And inflation is still raging. So there's a really, really critical question here is, have they left it too late, the Reserve Bank? Are they doing too little? Did they take rates too low? Probably the answer to all those is yes, but we are where we are. So that's why rates will have to go up. This is the first time in 12 years that we'll have successive rate rises month on month, and I would expect to see a series of rate rises through the rest of this year. The RBA is talking about an interest rate of about 2 to 2.25% by the end of the year. Some market analysts are saying it could be as high as 3%. Now, that would have a huge, devastating impact on households, particularly those with mortgages. The only sort of slight good news could be that some people with money in the bank, savers, may see a little more coming through on the saving side of the equation, but it's a really complicated and difficult situation. But I'm afraid that the Reserve Bank is partly responsible for creating it in the first place.
If it doesn't work, if inflation remains high and interest rates continue to increase, what are the consequences of that? What happens? Recession, doesn't it?
Yeah. Stagflation is sort of the official name for it, where effectively prices continue to rise, wages don't, unemployment rises, growth falls. And we had that, of course, in the 70s and the 80s. I can remember that. And it was a horrible, horrible time. We had interest rates, of course, that went up 17% in some cases in Australia, and that then dragged the housing market down, put a lot of people out of business, crushed a lot of small businesses. So that's the risk if we get it wrong here. The problem that I see is the Reserve Bank may, on one hand, not want to take rates too high too quick because of the amount of debt we've got in the system. We've got huge mortgages. We've got more mortgages in a head of population almost over any other country. On the other hand, if they don't do enough soon enough, then the problem gets worse and worse. And it's interesting that in the US, the Federal Reserve is saying we have to act quickly because if we don't, then the consequences in terms of recession or stagflation really are very difficult to tame. But I guess the question is this very weak lever that they've got, the interest rate lever, sufficient to deal with the things that we're looking at the moment? And I have my doubts.
So is that genuinely pretty much the only lever at their disposal? What else could be done at the government level, potentially, to save us from this doomsday scenario?
Well, there are clearly, if I look at the UK, there were a couple of things that they did. One of them was to actually put an excess profit tax on oil companies because, of course, the oil companies are making huge amounts because of the high oil price. And they've taken some of that money and they've flowed it back into the economy to help people with power bills. Now, I think there is a very important conversation to be had about how we bridge people through this. I almost think this is like another, COVID-type emergency that we're actually going through at the moment. And therefore, we need to think creatively about the other levers that can be pulled as well as the interest rate lever. I think interest rates do need to go higher to deal with the root cause, as we've discussed. But we just can't say, well, we're fine, everybody will cope. They won't. We know that, more than 40% of households are already struggling with that mortgage repayment now. We know that there are more than 2 million people in rental accommodation struggling to pay their rents now. And the inflation rate's raging away. So we need to find some alternative strategies, I think, to try and ease some of the pain. But I have to say that the next 2 to 3 years are going to be really, really difficult. And I think we are going to see inflation staying around for a lot longer than many people think. I think interest rates will have to go higher. That, of course, is going to put downward pressure on property prices, so people's paper profits that they've made over the last 2 or 3 years might start dissipating. That's going to be another negative too. So I'm afraid that this is a very complex, difficult, but uncomfortable journey that we're on.
Well, on that cheery note,
sorry about that.
No, that's okay. We got to hear this stuff, don't we? And we'll see what happens. I think a lot of people are tending towards the 40 basis points, which is a little scary.
One quick point. People should plan, use a cash flow, look at where they're spending their money, and start making decisions now about where they could trim a bit to create some capacity later. Just don't wait, for the wave to appear. Plan now is what I'd say.
Thanks for that, Martin. Thank you very much. That's Martin North, Principal with Digital Finance Analytics. What do you think, hearing what Martin had to say? Are you doing that already? Are you poring over your household budget and finding places where you can trim just a little, even if you don't need to right now, in anticipation of what we're expecting down the track, which is even more interest rate rises? And we've got to cross our fingers that it does, in fact, have that curbing effect on inflation. It's a slightly concerning time, isn't it? You're listening to ABC Illawarra.